Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. Welcome to another one of these quick market updates, and I just came across some news on what could possibly be some of the most undervalued stocks of the year. And Nation, when we look back at all of this in 10 years from now, I truly believe what we're going to look back and see this year as the single best investing opportunity of our lifetimes. I'm not talking about the stock crash or that 30% rebound. I'm talking about here is the way this virus is making so clear some of these universal shifts and trends in the economy. These trends we've seen develop over the last few years, like the rise of e-commerce and digital media, but that have just been magnified by these lockdowns. The last few months have accelerated those trends. And if you're watching, if you're paying attention, this is a great opportunity to get in on some of these stocks benefiting from it before the market has really priced in what's going on. So today I want to highlight one of those biggest shifts, the rise of digital advertising and how the last few months have really created some of the most undervalued stocks of 2020. I'll highlight the historic shift we're about to see over the next few months. Then I'm going to reveal 3 value stocks to buy right now and a few you absolutely want to avoid. Before we get into that though, I just got an email from the people over at Webull about a special contest just for those of you in the Let's Talk Money community. Today, May 21st, Webull is going to pick at random one of the new accounts funded through a link I'll put in the description below and give that person a third free share of stock worth between $30 to $300. Everyone here in the nation knows I've been using Webull for about a year now. It's got some great features for investors, and I love this stock simulator where you can try out your strategies before committing real money. You already get 2 free shares of stock just for opening an account and depositing that first $100. But today only, May 21st, anyone that makes their first deposit, you're going to be in the running for that third free share. And here's the email and how it's going to work. Now, I usually have from 10 to 15 people signing up on any given day anyway, so I think we can easily be in that second row here. And somebody is going to get a free share of Walmart for over $120. So look for that link in the video description below. Okay, sign up and make your first deposit of $100 or more. You're going to get those 2 free shares of stock for an instant return, plus be up for that third free share. Now for a little bit of background into the trend that we'll talk about today and those 3 undervalued stocks that we'll hit on. This is usually a huge week for the TV networks, okay, because it's when they sell 80% of their commercial space over the next year. This is an annual conference they call the Upfronts, where the networks reach out to all the ad agencies. They have this big conference to highlight the fall lineup of shows, and they pre-sell all the ad space on the network. But that's not happening this year, okay? Production on TV shows is all but shut down, so they don't even know exactly what's going to be on. And advertisers are holding off, with some even canceling some of their previous ad buys. In fact, a new report by Advertiser Perceptions forecasts a 33% cut in upfront commitments this year. Now, the growth in digital advertising isn't exactly new, okay? Internet ad spend reached $29.9 billion in the second quarter of last year and has increased at a 28% annual pace for more than 20 years. And if we look at the share of the U.S. ad spending by media, internet advertising has increased from just 6.4% of the total in 2006 to more than half of all ad spending this year. Anyone working in TV or those other traditional media sources should be pissing themselves right now just looking at this chart. Advertising on TV is plunging and it's all going online. What is new though is how the last few months is just accelerating this trend. Okay, Horizon Media CIO David Campanelli estimates that up to 30% of TV ad commitments are going to be canceled in the third quarter. And what we see if we dig into those surveys a little bit is we find that about half of those advertisers plan on replacing their TV ad commitments that they canceled with streaming and digital video. Now, for confirmation of this idea, I looked into my own ad rates here on the YouTube channel. So of course, YouTube collects ad revenue for all those annoying pop-ups and the pre-video commercials and then splits that with the channels. So I compared this year's rates by month to last year's, to 2019, and it just shows how fast internet advertising is bouncing back. Here you see in the December through February period, ad rates on YouTube were doing really well, like double digits above the 2019 rates. Then that virus hit and advertisers started pulling back. March rates were down almost 2%, and April fell off a cliff with a 13% drop in rates. But ad rates have already started to rebound and are up more than 3% year over year in those first 2 weeks of May. Now, obviously, that's just one person's YouTube account, but it does look like the ad rates have rebounded, at least in digital, and I don't think that's priced into stocks yet. Now, we'll look at those 3 most undervalued stocks next, but we're seeing a big difference here in the returns on shares in the digital space. You see, most internet stocks, especially the social media stocks, make all of their revenue off of that advertising. So when ad spending drops off a cliff like it did, the stock prices got hammered even though people were spending all their free time on those sites. Most of these stocks have rebounded, but they're still down from those February highs. And if this trend to digital ad spending does accelerate, like I think it will, you're going to see some huge earnings surprises from these companies over this next year. So a lot of these stocks might not look undervalued compared to where they were trading at earlier in the year. But when you look back in a year from now and you see how much money is poured into digital ads, these stocks are going to be way higher. My best pick here for undervalued stocks is Pinterest, ticker PINS, because it's probably the best example of an internet company that had a really solid first quarter, except for what the coronavirus did to its ad revenue. Now, Pinterest reported a 35% increase in its first quarter sales and 26% growth in its monthly users, and those are both on a year-over-year basis. It also booked a 6% increase in the revenue per user, which is really the metric you want to watch for in these internet companies. Okay, are they growing their user base, and are they finding new ways to make more money from each user, so more revenue per user? Now, why I like Pinterest over some of the other social media sites like Facebook and Twitter, besides the valuation, which we'll get to, is because Pinterest is much more of a search engine instead of just that news feed that you get on Facebook. You can find pins on the site for years after they've already been posted, and advertisers absolutely love that, so I think Pinterest is going to be getting a lot more ad spending dollars in the future. Now, shares are trading at just 8 times sales, which is about half the price to sales ratios that this one was getting at just this last September. And I think the shares could easily get to $25 each over the next year. Our next value stock here is Google parent company Alphabet, ticker GOOG. And I think these last few months have been a great opportunity to pick up shares of a company that is just going to keep on running for decades. Alphabet is down about 10% from its recent high, but if you're looking for one company that benefits from that shift to digital ad spending, this is it. Okay, Alphabet dominates the online search market with 80% of searches and has the top 2 trafficked websites in the world with Google and YouTube. And besides that obvious ad powerhouse with these 2 sites, though, Google has some big growth ahead in its cloud service and other projects like self-driving cars. Shares trade for just 5.6 times sales, which is pretty much where it's been over the last year, but sales are growing at 13% annual pace, and I think could ramp up on this theme that we're talking about. So definitely some value here for those long-term investors. Our next stock to watch here is IAC Interactive, ticker IAC. And this is more the traditional internet website model. Okay, IAC operates through different segments, different groups like the Match Group, which is a collection of dating sites accounting for about 43% of revenue. Angie Home Services, which is 28% of revenue, and video sharing sites like Vimeo, as well as Dotdash and some applications. Now, we saw a lot of those dating apps like Tinder, Match.com, and OkCupid just explode during the lockdowns as that demand skyrocketed. The home services site obviously took a hit, but this is a $400 billion market that's still 90% offline and could really help drive revenue into the future. Shares of IAC are off their highs by 13% this year, but trade for just 4.2 times sales. Revenue is growing at about a 12% annual pace, and that price to sales multiple has been as high as 4.8 times as recently as December, which makes me think the shares could easily get to about $300 each over the next year, which is about 25% higher than the current price. Now, these are my best picks for undervalued stocks, but there are a few others out there. And basically, you're looking for those strong online sites that haven't benefited as much from the rebound and have a great position in that digital ad space. Now, I want to highlight some of the other media stocks that could be hurt from this trend. Some of the stocks you might want to avoid. Before that, though, don't forget to look for that link to Webull in the video description below and make sure you're in the running for that free 3rd share of stock just for opening an account and making your first deposit. That's today only, so don't miss it. So there are a few media stocks like Comcast, Disney, and AT&T that also have that streaming services capability. That is partially going to protect them from that big shift in ad dollars, but you got to understand they also still have a lot of their business tied to that traditional TV model. So I'm not quite so sure about these. You have to be cautious and you have to do your research. Some of that streaming gain is definitely going to be offset by the pain in traditional media sales. Companies that have the most to lose, though, are going to be those in that smaller local broadcasters that maybe don't have their own online presence or streaming. These are going to be stocks like Gray Television, ticker GTN, and Sinclair Broadcasting, ticker SBGI. Click on the video to the right to avoid what could be the most dangerous theme for investors in 2020, the value investing trap. I'll explain the value investing trap and 3 stocks to buy instead. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.